You've read the books, you've watched the videos, you've bookmarked 17 different beginner investing articles you never finished. But here's the truth. You don't need 17 guides. You need one because investing isn't complicated. It's been made to look complicated. Every extra layer of jargon, every exclusive strategy, every subscription-only stock tip, it's mostly noise designed to make you feel like you need help. You don't actually need. The real reason most people never invest isn't lack of information. It's an overload of it. So let's clear all of that away. This is the only investment guide you'll ever need, the fundamentals in plain English that actually build wealth over time. Step 1, your money needs a job before it can grow. Before a single dollar goes into the stock market, it needs somewhere to live first. That's your emergency fund, 3 to 6 months of essential expenses, sitting in a high yield savings account, untouched. Why does this come first? Because investing is a long-term game. If your car breaks down next month and your only money is tied up in stocks, you might have to sell at the worst possible time just to cover the repair. An emergency fund is what lets your investments actually stay invested. Economist Milton Friedman spent decades studying how people make decisions about saving and spending across their lifetime, what's known as the permanent income hypothesis. The core idea: people who plan for smoothing out life's financial bumps end up more stable and more able to build wealth than people who react to every emergency as it hits. Your emergency fund is that plan in physical form. Step 2, kill high interest debt before you invest. Here's a question rarely asked directly. Why would you invest in the stock market, which historically returns around 7 to 10% a year after inflation, while carrying a credit card balance charging you 22%? You wouldn't, not if you did the math. Paying off high interest debt is mathematically one of the best investments available to you because it's a guaranteed return. Every dollar you put toward an 18% interest rate is a dollar earning you 18% risk-free. Once high interest debt is gone, then your money's ready to grow instead of just escaping fees. Step 3, understand what compound interest actually does. Albert Einstein reportedly called compound interest one of the most powerful forces in the universe. Whether or not he actually said it, the math backs up the sentiment. Here's what it means in plain English. When you invest, you don't just earn returns on the money you put in. You earn returns on your returns, and then returns on those returns. Every year, the snowball gets bigger, and it rolls faster. Invest $500 a month starting at age 25, earning an average 8% annual return. And by 65, you'd have contributed $240,000 of your own money. But the account, it would hold somewhere around $1.7 million. That extra $1.46 million isn't magic. It's just time and compounding, doing what they always do. This is also why starting late costs so much more than people expect. Wait until 35 to start that same plan. And by 65, you'd have roughly $745,000 instead of $1.7 million, less than half from losing just 10 years. Compound interest doesn't care about your excuses. It only cares about time. So the single most important investing decision you can make today isn't which stock to buy. It's whether you start now or later. Step 4, index funds are the foundation, not the sideshow. Here's where most guides get lost. They jump straight to picking stocks. Skip that. Here's why. In 2007, investor Warren Buffett made a public bet. A simple S&P 500 index fund would outperform a hand-picked portfolio of hedge funds over 10 years after fees. The hedge fund side had professional managers, years of experience, and complex strategies. The index fund won, not by a little. Buffett's simple, low-cost fund returned about 125% over the decade. The hedge funds, weighed down by high fees and underperformance, averaged around 36%. An index fund is simply a basket that holds a small slice of hundreds or thousands of companies at once. Think of the S&P 500 as owning a tiny piece of 500 of the largest US companies, all in a single purchase. You're not betting on one company surviving. You're betting on the economy as a whole, continuing to grow over time. Historically, that's a much safer bet. This is also why fees matter more than people realize. A fund charging 1% a year sounds small, but over 30 years, that 1% can quietly eat away roughly a quarter of your total returns. Look for funds with low expense ratios, often under 0.1% for major index funds, because the money you save in fees is money that keeps compounding for you instead of your fund manager. Step 5, understand your accounts before your investments. Here's a mistake that costs people tens of thousands of dollars, and it has nothing to do with which stock they picked. It's not using tax advantage accounts first. A Roth IRA is a retirement account where you contribute money you've already paid taxes on, and in exchange, every dollar it earns for the rest of your life is completely tax-free when you withdraw it in retirement. Here's why that matters. If you invest $6,500 a year into a Roth IRA starting at 25, and it grows for 40 years, you might withdraw it as $1.5 million or more at retirement and owe zero federal tax on any of that growth. Compare that to a regular taxable brokerage account where you'd owe capital gains tax on your investment growth. A traditional 401k works differently. Contributions reduce your taxable income now, and you pay taxes later when you withdraw in retirement. Many employers also match a percentage of what you contribute, which is, in simple terms, free money you should never leave on the table. The order that tends to make sense for most people: contribute enough to get your full employer 401k match first, then max out a Roth IRA if you're eligible, then go back and add more to your 401k if you have money left to invest. Step 6, understand what dividends really are and what they're not. Dividend investing gets romanticized as passive income, and there's some truth there. A dividend is simply a portion of a company's profit paid directly to shareholders, often quarterly. But here's the myth worth clearing up. Dividends aren't free money. When a company pays a dividend, its stock price typically drops by roughly that same amount. You're not gaining extra value out of nowhere. You're receiving part of your existing investment as cash instead of leaving it invested. That doesn't mean dividends are useless. Reinvested consistently, dividend-paying stocks have historically contributed a meaningful portion of the stock market's total long-term returns. But chasing high dividend yields alone, without looking at the underlying business, has burned plenty of investors who didn't understand what they were buying. Step 7, diversification is protection, not a limitation. Nobel laureate Harry Markowitz built an entire body of research known as modern portfolio theory around a simple idea. How you combine investments matters as much as which investments you pick. Spreading your money across different types of assets, US stocks, international stocks, bonds, reduces how much any single bad year can hurt you without necessarily sacrificing long-term growth. A common, simple starting point many financial planners point to: your age in bonds and the rest in stocks. At 30, that might mean roughly 30% bonds, 70% stocks. As you age, you shift gradually toward more stability. This isn't a rule carved in stone. It's a starting framework you adjust to your own risk tolerance. Step 8, understand the real psychology working against you. Behavioral economist Daniel Kahneman spent his career studying why humans make irrational financial decisions and won a Nobel Prize for it. One of his key findings: people feel the pain of losing money roughly twice as intensely as the pleasure of gaining the same amount. This is why investors panic sell during market downturns, the exact moment they should be doing the opposite. The market has recovered from every crash in its history. 2008. 2020, every single one. The investors who lost the most weren't the ones who stayed invested. They were the ones who sold at the bottom out of fear, then bought back in later, higher, out of relief. The single hardest skill in investing isn't picking the right fund. It's staying calm enough to do nothing while your emotions scream at you to act. Step 9, financial independence is a math problem, not a lottery ticket. The FIRE movement, financial independence, retire early, is often built around one simple rule of thumb, the 4% rule. If you can live off 4% of your total investments per year, your money is likely to last through a standard retirement based on historical market data. That means if you spend $40,000 a year, you'd need roughly $1 million invested to sustain that indefinitely. Spend $60,000 a year, and that number rises to $1.5 million. This isn't about getting rich quick. It's about figuring out your number, then reverse engineering how much you need to invest monthly, for how many years, at what return to get there. It's a math problem, and math problems can be solved. So here's how this actually applies to your next decision with money. Not your retirement decision, not some decision 20 years from now, your next one today. It's the coffee, or the subscription, or the impulse purchase that feels small enough not to matter. It's whether that money sits in a checking account earning nothing, or moves toward an emergency fund, a debt payoff, or an index fund quietly compounding in the background. You don't need 17 guides to build wealth. You needed one system, followed consistently for a long time. You've read the books. You've watched the videos. Now you actually have everything you need.